US markets are flashing red. If you looked at charts this week, you didn't need an explanation. The S&P dropped more than 2%, its worst day since 2025. In a single session, $1.2 trillion in market value vanished. Tech stocks collapsed, but that wasn't the real warning. The real signal came from the banks. JP Morgan fell more than 3%, and financials sold off hard. That's not random, that's capital reacting to risk. The real signal came from the banks. JP Morgan fell more than 3%, and financials sold off hard. That's not random, that's capital reacting to risk. When money starts pulling back like this, it's because confidence is breaking. And once that starts, the damage rarely stays contained. The most important part of this sell-off isn't how fast prices moved. It's where the pressure shows up. Tech selling is expected when markets shake, but bank selling at the same time sends a very different signal. Financial stocks trade on flows, credit conditions, and future demand for capital. When banks fall, the market is pricing in slower trade, tighter lending, and stress inside the system itself. That's why moves like JP Morgan Chase dropping more than 3% matter. Banks sit at the center of global money movement. If capital starts pulling away from US assets, banks feel it first. Timing also matters. Weak performance early in the year often reflects underlying damage, not noise. January selling tends to set the tone because it exposes where confidence is already fragile. This isn't chaos, it's alignment. Different parts of the market are reacting to the same risk at the same time. When that happens, investors aren't tweaking positions, they're reassessing exposure, and once that process starts, it rarely stays confined to stocks. Going after China was already damaging enough. The trade war slowed growth, distorted supply chains, and pushed costs higher across the global economy. But what came next crossed a far more dangerous line. A global trade war was unthinkable on its own. Turning that pressure on allies breaks the system entirely. That's because the United States does not operate in isolation. It relies on cooperation, trust, and capital from the very countries now being targeted. Yes, the US economy is stronger than Europe's when it comes to consumer markets, technology, and scale, but strength does not equal independence. The United States is heavily dependent on foreign capital, and Europe plays a central role in funding America's deficits. European institutions hold 40% of all foreign-held US Treasuries. That is more than China and Japan combined. This is not a marginal detail. This is the backbone of demand for US government debt. And the timing could not be worse. The US is running massive deficits while trying to do everything at once. Rebuilding domestic supply chains costs trillions. Expanding the US military costs trillions. Fighting China without triggering a recession costs trillions. Rebuilding Venezuela, asserting control over Greenland, and projecting power globally all come with enormous price tags. On top of that, there are unfunded liabilities, social entitlements, and rising interest payments that grow larger every year. All of this requires constant borrowing, and borrowing only works if buyers keep showing up. China is no longer that buyer. BRICS countries are not stepping in. That leaves Europe. European money has been quietly filling the gap month after month, year after year. This is what makes the strategy so reckless. Antagonizing the largest remaining source of external funding puts the entire US financing model at risk. The reality is simple. The United States needs Europe's money more than ever, and that dependency is about to collide with politics in a very dangerous way. At this point, the buyer list for US debt is getting very short. The BRICS countries are no longer stepping in. They are not absorbing new Treasury issuance, and they are not stabilizing demand. BRICS has moved on. That leaves one major player already heading for the exit. China has been selling US Treasuries month after month. Its holdings are now down to $682 billion, the lowest level since 2008. This is not a temporary adjustment. This is a long, deliberate unwind. With China pulling back and BRICS staying out, there should have been a funding crisis already, but it didn't happen. And the reason is Europe. European institutions quietly became the shock absorber for the US bond market. They kept buying while others were selling. They filled the gap. Without that support, yields would have spiked much earlier. The numbers make this clear. The United Kingdom alone increased its Treasury holdings by $148 billion last year. France added another $41 billion. These are not symbolic purchases. This is real money flowing into US government debt at a time when alternatives were shrinking fast. European demand has been directly countering China's sell-off and keeping the system functioning. That is why the situation is so fragile. The US Treasury market is not being supported by a broad coalition anymore. It is leaning heavily on one group, and that group is now being openly pressured, threatened, and antagonized. This is not about ideology, it is about cash flow. When the largest remaining buyers feel politically targeted, their willingness to keep funding deficits changes quickly. This sets up a dangerous contradiction. The US needs constant demand for its debt, yet its own policies are pushing away the very investors providing that demand. And once that balance breaks, the bond market reacts faster and harder than stocks ever could. As pressure builds in the bond market, the response from Washington reveals just how fragile the situation has become. This is where Treasury Secretary Scott Bessent steps in. Speaking at the Davos summit, he addressed growing concerns among US allies at a moment when capital flows are already under strain. What matters here is not the setting, but the timing. This was not a closed-door discussion. It was a public intervention, delivered while European governments and investors were openly reassessing their exposure to US assets. When Treasury officials feel the need to speak directly to allies during market stress, it tells you the risk is no longer theoretical.
Again, I would say this is the same kind of hysteria that we heard on April 2nd. There was a panic. And what I am urging everyone here to do is sit back, take a deep breath, and let things play out. As I said on April 2nd, the worst thing countries can do is escalate against the United States.
That statement wasn't reassurance. It was damage control. Bessent understands what happened after Liberation Day, when tariffs triggered a sell America moment across stocks, bonds, and the dollar. He knows how fast confidence can break once allies start behaving like creditors instead of partners. Bessent went further. He framed any European response, especially over Greenland, as unacceptable. If Europe pushes back, consequences will follow. That kind of language does not project stability. It tells markets that Washington is worried about retaliation because retaliation now carries financial weight. This is the real problem. Europe is no longer being treated as a partner. It is being asked to absorb pressure. Investors hear that. Funds hear that. Central banks hear that. And when the world's largest debtor starts warning its creditors to stay in line, the bond market listens very carefully. The bond market has been here before. After Liberation Day, tariffs triggered a full sell America moment. The dollar fell, US bonds sold off, equities dropped more than 10%, confidence cracked fast. What's different this time is who's involved. This is no longer just about China or speculative traders. Now US allies are starting to move. The first clear signal came from Denmark. Academia Pension, one of the country's major pension funds, decided to dump US Treasury bonds. The size of the position matters, but so does the symbolism. The fund holds only about $100 million in US debt in 2025. That amount alone will not move markets tomorrow. It is not big enough to cause an immediate panic, but it does something far more dangerous. It sends a signal. Large institutional investors do not make political statements lightly. When a pension fund steps away from treasuries, it forces others to ask the same question. Do we still want to hold dollar assets? Especially when buying US bonds increasingly looks like financing Washington's military expansion. Greenland is no longer just a geopolitical issue. It has become a financial trigger, and this is where political pressure turns into forced selling.
European countries and Canada were not meeting their spending quotas as a percent of GDP. Now they are. They got a lot of catch up to do. And Maria, to put it in perspective, the United States of America since 1980 has contributed $22 trillion more dollars, or spent $22 trillion more dollars on defense than all of NATO. So roughly the same size population, and we have spent $22 trillion more. That is 2/3 of our outstanding government debt. The Europeans have been spending the money on social welfare, on roads, on education, and it's time for them to pay more, which they've agreed to do.
After that statement, the logic becomes unavoidable. European economies are already stretched. They are funding Ukraine. They are trying to keep industries alive. Now they are being told to spend trillions more on defense. Issuing massive new debt would crush their own economies. That leaves one realistic source of funding: selling US Treasuries. This is why the Danish move matters. It doesn't start the fire. It shows where the exits are. And once investors start mapping those exits, the bond market reacts quickly. Once the selling starts in the bond market, the damage moves fast. The 10-year US Treasury yield surged to 4.3% before pulling back slightly to 4.29%. That move might look small on the surface, but it isn't. Yields jumped nearly 20 basis points in just a matter of days. For long-term bonds, that is a violent shift. It signals heavy selling and a sudden loss of confidence. Long-duration treasuries were dumped first. That's where fear shows up earliest. Investors were not rotating, they were exiting. And when yields rise this quickly, the effects don't stay inside the bond market. They spill straight into the real economy. About 70% of US GDP is driven by consumption. That means the economy depends on people borrowing, spending, and using credit. Higher yields make all of that harder. Mortgage rates rise, auto loans get more expensive, credit card balances cost more to carry, companies face higher financing costs at the exact moment demand starts weakening. The result is predictable. Spending slows, expansion plans get shelved, hiring freezes follow, and the labor data already shows the stress building. In November, the US had 7.8 million unemployed people. At the same time, there were only 7.1 million job openings. That works out to just 0.9 jobs available for every job seeker. That is not a strong labor market. That is a market already under pressure. This didn't happen in a vacuum. These numbers reflect months of tariff pressure and weakening consumption. And when rising yields pile on top of that, the system tightens fast. Once borrowing costs climb, the economy doesn't bend slowly, it snaps. And the bond market is already telling you that the snap is underway. The biggest risk now sits in Japan. Once pressure reaches Tokyo, the fallout becomes systemic. After the prime minister called a snap election, Japan's bond market came under immediate stress. Yields moved quickly, confidence started to crack, and investors did not wait for clarity. They sold. The pressure grew so intense that even Scott Bessent began pressing Japan to rein in its bond market volatility. Yields on Japan's long-dated bonds surged. The 30-year and 40-year yields jumped by more than 25 basis points in just a matter of days. In less than a month, the 30-year yield climbed from 3.4% to nearly 3.9%. That is an extraordinary move for a market that is supposed to be stable. Life insurance companies and large funds started trimming exposure, adding more pressure to the system. This matters far beyond Japan. The country holds over $1.2 trillion in US Treasuries. For decades, those bonds served as reserves of last resort. And that is exactly when reserves get used. Japan is facing a currency crisis. The yen is down 34% despite multiple interventions. There have already been 4 attempts to support the currency, and each one bought at most 6 months of relief before the pressure returned. To stabilize the yen, Japan needs dollars, and the fastest way to get them is by selling US assets. This is why Washington is watching Tokyo so closely.
It's going down because the Japanese bond market had a 6 standard deviation move for the past 2 days. That would be in their 10-year bonds. I've been in touch with my economic counterparts in Japan and urged them to take the necessary measures to stabilize their bond market, but that's spilling all over into all bond markets. German yields are up, French yields are up, US yields are up. It's mostly the Japanese bond market, got nothing to do with Greenland.
That explanation doesn't hold up. Japan's bond stress didn't appear in isolation. It's unfolding alongside rising US yields, European tension, and growing pressure on Treasury demand. Blaming Japan avoids the deeper issue. If Japan is forced to sell, it won't be a policy choice. It will be a necessity. And once that happens, the shock won't stop at Japan's borders. The rules-based order is over. Even Mark Carney is saying it out loud now. Decoupling is accelerating, new alliances are forming, and blocs like BRICS are getting stronger by the month. The dollar and US Treasuries are no longer treated as the unquestioned gold standard. This shift isn't cyclical, it's structural. There are still 3 years left in this presidency, and the pressure to dump dollar assets is only going to intensify. There is no return to a unipolar moment. That era is done. So here's the real question. Will US allies keep selling treasuries? And which G7 country is the next to break away? Let me know what you think in the comments. And don't forget to like and share the video, it really helps the channel. Thanks for watching and see you in the next one.